Ladies and gentlemen, welcome to our latest edition of our Basel 4 channel. Today we are again speaking about credit risk and here especially about the IRB approach. And when we speak about the IRB approach, it's always very important that we don't look only to the proposals from the Basel Committee. We also have to look to the proposals coming from other supervisors, like for example the EBA and the ECB. And the EBA and the ECB, they were giving some additional requirements, especially for the parameter estimation of the IRB approach. And remember, there are four main parameters for the IRB approach: the PD, the LGD, the CCF, and the maturity. Today, I'm not doing the Basel 4 channel alone. I have a very good expert here with me. Lisa,
Hi,
would you like
Martin.
to introduce yourself?
Hi, my name is Lisa. I'm a manager of a fast regulated management department from PwC. We're specializing on quant topics of IRB modeling. And today I'm happy to give you some insights about the risk parameters estimation.
Perfect. I'm very happy that you're here together with me. Lisa, as I mentioned before, there are four main parameters that must be estimated for the IRB approach. For that we are able to derive or to calculate the IRB risk rate. It's the PD, it's the LGD, the CCF, and the maturity. What do you think, you as one of the most experienced PwC staff that is working on parameter estimation, what is the most difficult parameter to estimate?
I would say it's LGD currently.
The LGD. Why is it?
Well, it's quite complex and we have not only one LGD parameter right now, but a lot of add-ons and different types of LGD parameters like LGD downturn, MOC, LRA LGD, realized LGD, expected loss best estimates. Yeah.
Oh, that sounds really complicated. So it's definitely worth to do a Basel 4 channel on it, and that's what we are going to do today. But we are not alone. We have another colleague that is very experienced on the model estimation and model development and parameter estimation. It's Kaan Aksel. Hello Kaan, thank you very much for joining us today in our Basel 4 channel with a special topic LGD. Maybe could you introduce yourself?
Hi everyone, this is Kaan Aksel, working here in Frankfurt and covering the analytical risk parameter estimation topics for many years. I would like to discuss about some interesting aspects of the new requirements that has been imposed by Elbe paper coming out towards the end of last year, and here our discussions will contain a lot of technical details which are posing significant hurdles for all the credit risk modelers across the European continent.
Okay, let's have a look into the presentation.
We will be having slide number 5 as the first slide of our discussion. Here, the important element is this slide is basically providing an overview of the LGD parameters based on the upcoming future requirements imposed by Elbe paper. We basically differentiate between the closed cases and incomplete cases. It's always the situation with the observed loss on credit exposures. For the closed cases, the observed LGD needs to be recorded, which is the requirement as of the last Elbe paper. Estimation for the incomplete cases is also required simply because we need to forecast as well the expected loss on incomplete cases to figure out what are going to be the future recoveries, and that will be obviously dependent on the maximum length of the recovery process. And that needs again to be estimated from facility to facility for the retail or for the counterpart exposure for the non-retail part. The long-run average LGD is the basis for all the estimation of the various LGD components, which, as you might observe on the slide, are the LGD downturn, the margin of conservatism, which is an additional buffer for any possible estimation uncertainties, and finally the LGD on the estimate for the performing portfolio, as well as the LGD in case of default for the non-performing portfolio. Parallel to this, when you look to the upper part of that slide, you'll also realize that there is a case of expected best estimate loss based on defaulted exposures. Here we need to make an estimate for the given next 12-month economic environment or economic circumstances, and what the impact would be on our expected losses on LGD cases. This is a forward-looking approach, and where we incorporate the forward-looking aspects. Whereas the lower part for the LGD estimation, where we have been discussing the downturn LGD MOC and the average LGD for the performing exposures that has to be for regulatory capital calculation purposes, all need to be based on historical observation, and then there are obviously through the cycle averages. The difference lies in the fact that we need to account for the differences between the best estimate LGD and the average LGD for the performing portfolio, simply because for any surge of expected losses in the near future for the next 12 months, the difference we have to account is the shortfall for IRB capital requirements, and that needs to be again covered by additional risk-weighted assets, henceforth by additional capital. We differentiate in general terms, which is what you can see on slide number 7, between the pre and post default models when it comes to LGD. And here we can easily observe that we have again all this components that needs to be basically calculated both for pre-default LGD estimate as well as post-default model. There, we need to make sure that we also sometimes come across the term LGD in default, which is interchangeably used for the term of the post-default models. There are, again, as you see on the left-hand side of that slide, the same LGD parameters in place. These are the margin of conservatism, the downturn LGD, the best estimate expected loss. As the pre-default model is being designed and basically set up based on data that has been available at the time of default or before the default, and the post-default model has been basically designed based on the available data upon the default until the end of the so-called recovery period. We are looking actually to the same phenomenon at different points in time. And given that the drivers, the so-called elements of risk-driving factors, would be or could be completely different for these two models, and two models are both needed for the different parameters as we go along the line of the historical observation. The MOC is the additional buffer for the reflection of the uncertainties around our estimate. As we mentioned earlier, the downturn LGD will be providing us an estimate for the stressed economic circumstances to reflect the downturn conditions experienced by the entities, by the banks for the given time period. And the long run average realized LGD is actually based on both realized closed and incomplete LGD cases, which will incorporate both elements of forecasting based on historical data for the incomplete loss cases and for the existing estimation of the realized average cost of loss. And this is basically the base model. One should not really forget this and lose it from the sight. The best estimate for expected loss is also needed, which is going to be reflecting current economic circumstances and their impact on the estimated cash recoveries on our loss cases. On the next slide, what we can observe is the loss estimation can differ between pre- and post-default models. what really matters is here, when you look to the lower part of that particular slide, you can observe that at the time for the pre-default model, which is the one which is a bit, highlighted with the purple background color, where we have this 100 item total outstanding balance as to be recovered, where we see this is this information is based on one observation in historical observation period, and which is available before and or at the time of default. Whereas the all other recoveries that happened in the coming period of time, which we have identified here as 90, 80, and 70, that might be within or outside of the so-called recovery observation period, that all happened in the so-called post-default time period. So basically, if we have 2 or if we have 3 different observations, that will all be used for forecasting purposes. Again, the forecasting horizon is dependent on the so-called recovery period in question. If it's 2 years, it could be 2 years. If it's 1 year, it could be 1 year. If it's 3 years, it could be 3 years. But at the end of the day, you have 3 observations for each and every one of them. You use it as your target variable if you want to create a so-called post-default model and try to figure out what are the basic risk factors and drivers for this. Whereas for the pre-default model, you have only one observation where you need to find at least a year ago, depending on your frequency of observations of risk drivers. Quarterly forecasting could be as well applied here. But the bottom line is we are talking here about 2 different samples, and we are talking about here the same cash flow process, but observed at different points in time. We have, as we mentioned earlier, according to the Elbe papers, the following requirements. We have realized closed LGD that we need to report, and we have realized closed and incomplete LGD, which are both point-in-time estimation elements. On the top of that, for the through the cycle, we need to use the observed average LGD estimation and long-run realized average LGD estimation, which are both based on through the cycle estimation procedure, will be part of the capital charge calculation, obviously. But the critical element, the difference is the observed average LGD is not including the incomplete cases, whereas the long-run average LGD is including the incomplete cases in the estimation procedure. And all of this need to be calculated for both pre- and post-default estimates. On the slide number 10, what we do have here is if you don't have for the long-run average LGD estimation all the completed recovery cases, we can use 2 methodologies. One is based on the numbers of recoveries, and the other one is based on the amount of recoveries. The number of recovery cases can be designed as such that they will represent the future recoveries as a ratio of the future recoveries to the average future recoveries. And here we can create a simple and easy regression line where we can try to forecast based on the existing recoveries and past recoveries the regression line with an intercept so that we can have a rough forecasting mechanism in place, which can, given the available information, tell us what was the final recoveries in the future. The same can apply for those cases where we have attached a collateral. The first approach is usually only applied if no collateral is attached, but if you have collaterals attached, then you can obviously use a haircut approach where you link the haircut to the existing local housing price index, for instance, if the recoveries are based on liquidated assets, real estate assets in the respective loan engagements, loan exposures. Last but not least, on my part, before I hand over the word to my colleague Lisa, the identification of maximum expected recovery period is relevant for us because that will give us the exact timing when the recovery period should be ended and how long the recovery period should be in more or less general terms. Here we wait until usually the exposure amounts are covered up to 95% of outstanding exposure, which is a threshold which can be moved up 5 or 10% down depending on the available data, and we are usually waiting to find out what is the 95th percentile of recovered cases so that we can set up the data such that the recovery period is stretched out to this percentile recovery amount. And now I think my colleague Lisa will be talking more about the individual components, starting with the downturn LGD.
Thanks a lot, Kaan. Now I would like to focus on downturn estimates. Currently, CRR requires that LGD estimates should reflect the downturn conditions if these estimates are more conservative than the respective long-run average. Despite the fact that the main idea of downturn effect is clear, regulatory requirements still lack detailed rules on what the downturn conditions are and how to apply them in the risk estimation process. Therefore, a wide variety of approaches are currently used by banks to address an economic recession. In order to introduce consistency across banks and jurisdictions, EBA developed a draft RTS on the nature, severity, and duration of economic downturn for the purpose of LGD estimation. Basically, LGD downturn represents the LGD resulting from the long-run average LGD that is stressed in order to reflect downturn economic conditions. LGD downturn is estimated for both performing and defaulted exposures. There are three approaches available for the estimation of LGD downturn proposed by EBA. First two approaches, the model component approach and the reference value approach, are direct, separate estimation of long-run average LGD and LGD downturn. The third approach is supervisory add-on, and it is based on estimation of expert add-on. In 9 cases out of 10, we usually advise to use model component approach, and I will explain why later. First, let's focus on the differences between the proposed approaches. Model component approach is based on the dependency of model components on macroeconomic factors. The methodology is quite straightforward, however, it is highly complex and requires a lot of data. Reference value approach is an alternative approach to a model component approach with a bit more flexibility to use own methodologies and approaches to estimate downturn. Here we don't have strict steps prescribed by regulator that we need to follow in order to come up with LGD downturn. However, the resulting downturn LGD has to be compared with a reference value. And the third approach, supervisory add-on approach. However, here we need to keep in mind that it is the latest desirable approach in current EBA hierarchy. For this approach, banks may estimate downturn add-on on the top of long-run average LGD. Comparing all these characteristics, preferential approach is model component, of course. However, as I said, it is complex and requires data, but the methodology is quite straightforward. It is described in the draft paper of EBA, and I would say with the use of this approach, it is possible to obtain reasonable results. Now I'd like to focus on model component approach and high-level methodology that can be used for downturn estimation. First step after the data gathering would be identification of model components. It is done by performing an analysis of realized LGD distribution. The most common model components are cure rate, LGD at the time of cure, and LGD at the time of liquidation. The logic behind is very simple. Losses at the time of cure are very small and usually close or around zero, and losses at the time of liquidation are dependent on the type and value of collateral and collection or recovery unit processes. The next step would be to identify relevant economic factors and find the worst one-year periods for all of them. Worst years can be grouped in scenarios, since the requirement regarding the data is to cover 2 economic cycles, that means 2 downturn periods. And after grouping, banks may calculate 2 LGD downturn estimations. in case two downturn scenarios were identified, and the maximum of these values would be the final LGD downturn estimation. Approach is complex, requires 20 years of data history, but the logic is quite straightforward, and methodology is understandable, and in case of data availability, it would be relatively easy to model and document this approach. And let's quickly discuss the other two approaches, starting from the reference value approach. Here, the downturn is identified by relevant economic indicators. The approach is similar to model component approach. However, banks have a bit more flexibility, and they may use own methodologies for identification of the relevant economic indicators, but from a minimum list provided by regulator. The resulting downturn LGD has to be compared with a reference value that is derived by taking the average of the two highest LGDs of bank's history, or even with a European-wide benchmark that can be provided by regulator. Non-compliance with the reference value would have to be explained to the regulator and as well documented, and reference value as well can be used as a floor for the final downturn LGD. LGD downturn based on supervisory add-on approach is estimated as long-run average plus an add-on, which is based on an analysis of observed credit losses. There are two options for the design of add-on. First one is distributional approach. It is standardized methodology with the aim of capturing the tail of the distribution of observed recoveries per generation of default, and downturn add-on is derived from the observed volatility of recovery vintages. And the second one is downturn discounting rate with fixed add-on. In this approach, the LGD downturn is based as well on the long-run average LGD and depends on the discount rate and base rate. On the next slide, we may quickly go through the simplified example of application and use of model component approach. And I hope that after this example, the high-level methodology would be clear. Let's start with the step one. Here we made an analysis of realized LGD distribution, and we have noticed that there are two concentration points. So it is good to define three model components and differentiate the losses at the time of cure and at the time of liquidation. Step two, for every model component, we identified relevant economic factors. For cure rate, there are two main factors, GDP growth and unemployment rate. For LGD liquidation, we have two factors as well, HPI changes and credit losses. And for LGD cure, we have identified only one dependent factor, interest rates. And let's move to the step three. For every economic factor, worst years were identified. For GDP growth, it was 2001, HPI changes 2008, and so on as presented on the slide. Step number 4. Worst years were grouped into downturn scenarios. We see two downturn scenarios here. Scenario A for the year 2001 and scenario B for the years starting from 2009 till 2013. And we are moving to the step number 5, calculation of LGD downturn for each scenario. For the first scenario, scenario A, we identified only worst cure rates, and all other model components are replaced by long-run average values. For the scenario B, we have a case where two worst years were identified for the LGD at the time of liquidation. In such cases, we just need to take the maximum of two values. And step 6, finally, where we need to take a maximum of two downturn LGD values for two scenarios to get the final LGD. I would say this approach is pretty easy in theory until we approach and until we analyze the data. And now I would like to move to MOC, to margin of conservatism. The purpose of the MOC is to ensure that the risk parameters are conservative enough. This add-on is added on top of risk parameters to make estimation more conservative. In the new guideline, EBA introduced a structured framework in which all deficiencies might be clearly identified, classified, quantified, and mapped into a specific category. All the deficiencies are covered by explicit margin of conservatism adjustments and are properly monitored and documented.
Yeah, thank you very much, Lisa. Until now, it was already a very impressive presentation. Thank you very much. It seems to be quite complicated, this relation between the margin of conservatism and the models itself and how to include it. I have one question. Would it not be maybe possible to develop models that directly include the margin of conservatism instead of developing a model for the downturn LGD and then adding up the margin of conservatism?
That is a really good question. Actually, it's not acceptable right now by ECB, and banks have to separate LGD models and MOC add-on. Currently, all the banks were developing models that were conservative from the very beginning, and now we have to separate this.
Okay.
And let's have a look at the slides.
Okay.
As you see on the slide, the implicit conservatism already included in models for underlying assumptions can often result in excessive conservatism. By removing implicit MOC from the model development process and calculating it explicitly, that means outside of the main model as an add-on, banks can potentially lower the overall level of risk parameters. Even if this is not the case, explicit MOC provides better insight into the true source of deficiencies and the true cost of deficiencies. This will in return provide an incentive to solve deficiencies over the time, resulting in gradual decrease in MOC and reduction of risk-weighted assets as a result. Now we're reaching the expected loss best estimate. Expected loss best estimate is the best estimate of the expected losses for defaulted exposures. Regulator doesn't have any specific methodology to derive Elbe. However, there are some preferences and restrictions. Expected loss best estimate should be estimated only for defaulted exposures, and risk weights for the defaulted exposures are estimated as a difference between LGD in default, that consists of LGD downturn plus MOC, as you may see on the slide, and Elbe.
Okay, Lisa, thank you very much. What I understood now is that there are two different kinds of LGD. There's on the one hand side, there's the downturn LGD, and on the other side, there's the LGD best estimate. And the downturn LGD is used for the risk-weighted assets formula, for the calculation of the risk weights, and the best estimate is used for defaulted exposure when you compare the risk provisions with the expected loss, and if there's a difference, you have to deduct it or you can include it in your Tier 2 capital, depends on what is higher. What I know is that banks were investing a lot in their accounting models, and in the accounting models, especially for IFRS 9, they are also estimating an expected loss based on the current economic conditions. Would it not be possible to use that estimate also for regulatory purpose?
Yeah, you are talking about IFRS 9 models that banks were developing for a couple of recent years. However, in the most recent published paper about PD and LGD guidelines for estimation, now it is restricted to use IFRS 9 models. And you may use IFRS 9 models only in one case, if your IFRS 9 model is compliant with new regulatory requirements, current and upcoming. And I would say in most of the cases, IFRS 9 models are not compliant, and that means that you need to redevelop the model.
Okay.
Currently, we see four options to derive expected loss best estimate. The first one is the most simple. Your expected loss best estimate equals LRA LGD. Second one is a separate, fully fledged expected loss best estimate model. The third one is the option for banks with lack of data, LGD macroeconomic model on a portfolio level or on a calibrating segment level. And option number 4, the trickiest one, is the use of IFRS 9 model. Let's focus on the differences of the approaches starting from the use of current long-run average LGD model. Current LRA LGD can be used only if one of the following is true. The first point is that the model should be sensitive to economic conditions by using directly at least one macroeconomic factor as a risk driver, or at least one material risk driver that is sensitive to economic conditions. And point 2 is related to the fact that realized LGDs are not sensitive to the economic conditions at all. A benefit of this approach is that there is no need to develop and maintain an extra model, and as a result, an effort is low. The second option is a separate fully fledged Elbe model. This model can be developed on a basis of LRA LGD model by combination of existing risk drivers with macroeconomic factors, including macroeconomic submodule, for example, or even completely new set of risk drivers. In future, of course, this Elbe model can replace long-run average model in case the model would be sound and reliable. And banks that would like to follow this approach should keep in mind that additional resources would be required to develop and maintain the model, and as well an approval of a regulator. The third option, a portfolio-level macroeconomic model. This model can be developed on a portfolio level using realized quarter or monthly LGDs as dependent variable and relevant macroeconomic factors as explanatory variable. Relatively easy to develop a portfolio-level model in case of availability and in case of reliability of data. However, certain statistical and quantitative issues may arise, like lack of sufficient predictive power. And we need to keep in mind that for this option, additional resources would be required to develop, maintain, and document the model. Option number 4, the use of IFRS 9 models, is available only in case the models are regulatory compliant. Of course, if banks would follow this option, an approval of regulator would be required, and SSM would be investigating the models deeply. And as a conclusion of all discussed methodologies for banks that are thinking to start LGD models redevelopment process, I would recommend to consider the model component approach. Model component approach can be the basis for all LGD estimates, LGD parameters. For LGD model, it may help to capture the dependency between model components and risk drivers for a more accurate forecast. For LGD downturn usage, the model component approach is pretty straightforward. You just need to follow the recommendation of regulator. And for expected loss-based estimate model, it is quite easy to incorporate macroeconomics in the model components. However, you would always need to keep the balance between the number of model components and manageability of the model.
Yeah, thank you very much, Kaan, for the presentation so far. It's really interesting and seems to be a really big challenge for our clients. As a summary, what do you think? What are the biggest challenges of our clients with regard to LGD modeling?
I think the key implication is that the new requirements predictates that we have to be collecting the data anew, and we need to be calculating different components that never been required in the past. More importantly, we need as well make sure that the same data set has been used in the design and set up for all the components. So in a nutshell, what we are saying is here, most of the models had to be redeveloped from scratch, and this is humongous work for any bank in question here.
Okay. So as a conclusion, Kaan, does it really mean that banks have to redevelop all their LGD models?
Some of them, I would say most of them would have to, simply because many banks have used very simplified methodologies in the past that cannot be meeting all the requirements of the new guideline. So given that, I think the answer is yes, most of them will be using it. The simple segmentation methods, simple time series based approaches, they will need definitely to be adjusted for the new requirements. Unfortunately, for most retail and SME bank portfolios, we don't see any other option at hand right now.
Okay, thank you very much, Kaan. Thank you very much, Lisa, again. I think now you convinced me that the LGD parameter is definitely the parameter that is the most difficult to estimate. So thank you very much. Thank you very much also to you. I hope you join us again in our next Basel IV channel and hope to see you soon. Bye-bye.
Bye-bye.